Hi, good evening to my professor, Mr. Jerome and Sir L. I'm Sushra Ravindran. So today I'm going to briefly explain about the corporate finances assignment. So let me begin with the question one. So this is the question that was given by my professor. So the first question is analyze the ratios and prepare a report on the company's performance over the 3 years. So the report must analyze all the ratios included below. So as you can see in the table, there is ratio column, formula, and also the year. So the formula is given there. So let me explain about all the liquidity ratio, activity ratio, and other ratios below as followed. So let me begin with the liquidity ratio. So the formula is given there and the value for 2021 is 0.59 and 2022 is 0.59 and 2023 is 0.71. So the current ratio decreased in 2021 and 2022 but increased somehow in 2023 since it could be challenging for the company to pay off its short-term creditors with its short-term asset. A current ratio below 1 indicate potential liquidity issues in the company. So followed by the quick asset test ratio, where the formula is current assets minus with the inventory divided by current liabilities. So the values are given there. So as from my observation, the quick ratio remains low overall, but it shows a fall in 2022 and a minor improvement in 2023. This implies that the company lacks the liquid assets necessary to pay down its debts right now without having to sell any of the company's inventory. So followed by inventory turnover, where the values for 2021 is 1.95, 2022 is 0.69, and 2023 is 0.94. So as from my observation, the inventory management inefficiencies are shown by a notable drop in turnover during the 2022 and a minor rebound in 2023, which indicates the inefficiency in managing of the inventory of the company, which lowers the turnover, so suggesting overstocking or slower sales, which is occurring in the company. So next is average collection period. So 2021, the value is 0.40. 2022 is 0.40 as well, and 2023 is 0.19. So the average collection period remains stable in 2021 and 2022, but improved in 2023, indicating that the company is collecting receivables faster, which enhancing the cash flow management. So followed by the question for the ratio average payment period. So as for the value during 2021 is 0.91 and 2022 is 0.67 and 2023 is 0.51. A tendency toward a shorter average payment period indicates that the business is paying its suppliers faster, which may indicate a strong liquidity or a possible pressure on cash reserves inside the company. So which suggesting that the company is paying its suppliers more quickly compared to before. So next is total asset turnover, where the values for 2021 is 0.70, 2022 is 22.73, and 2023 is 2.05. So in 2022, the overall asset turnover increased dramatically. However, in 2023, it declined drastically. Further research is necessary since 2022, rise is unusual and could point on an unusual occurrence or a shift in asset usage by the company. Okay, followed by the next slide is debt ratio, where the formula is total liability divided by total assets. So the values for 2021 is 4.27 and 2022 is 1.21 and 2023 is 0.67. So over the duration of the 3 years, the debt ratio significantly dropped, indicating that the company depended less on the debt financing, which declined the financial stability. So followed by the debt to equity ratio is which means the over time the debt to the equity ratio increased indicating that the business is using debt more frequently than the equity, which could raise a financial risk, which could be a concern if not managed properly by the company. So next is time interest earned ratio, where the value is 0.37 during 2021, 17.02 during the 2022, and 0.27 during the 2023. So in 2022, the times interest earned ratio peaked, but in 2023, it sharply declined. The volatility suggests different degrees of ability to pay back the interest expenses, which may be brought on the changes in the earnings interest cost. Okay, followed by the next slide, profitability ratios, where the gross profit margin. So the values during 2021 is 36.31%, and 2022 is 34.15%, and 2023 is 30.92%. So over the duration of the 3 years, the gross profit margin decreased, indicating a decline in the core operations profitability, which is occurring in the company itself. So followed by the operating profit margin. So the values during the 2021 is 13.97%, 2022 is 13.71%, 2023 is 13.55%. So there is a little drop in the operational efficiency or an increase in operating costs, which indicating that indicated by the operating profit margin. So followed by the next slide, which is net profit margin. So the formula is net profit after taxes divided by sales times by 100%. So the values are 10.21 during 2021, 9.94 during 2022, and 9.30 during 2023. So there is a gradual decline in net profit margin, reflects overall decreasing profitability. So followed by next is return on assets, which is known as ROA. So the values are 19.31 during 2021, 19.09 during 2022, and 17.45 during 2023. So there is a decreasing ROA, shows declining efficiency in using assets to generate more profits. Okay, followed by the next slide is return on equity, which is known as ROE. So the values are 99.20% during 2021 and 97.78% during 2022 and 99.04% during 2023, which shows stable ROE values suggest strong returns to the equity holders despite their financial challenges. Next is EPS, which is known as earning per share. So the values for 2021 is 2.36, 2022 is 2.43, and lastly 2023 is 2.65. So which indicates there is an increasing EPS, indicating growing profitability on per share basis. So followed by the next slide is market ratios, where the values for 2021 is 589.30. For 2022 is 552.28, and lastly for 2023 is 529.24, which shows a declining price over earning ratio, suggests a decrease in the market valuation relative to the earnings. So the last one is market book ratio, which is known as MB ratio. So the value for the 2021 is 2.37, and 2022 is 2.48, and lastly for 2023 is 2.67. So it indicates there is an increasing market book ratio, indicates a rising market valuation compared to the value book value. So that's all from my side, followed by my teammate. They will explain regarding the other questions. Thank you.
A very good evening to my esteemed finance management lecturer, Mr. Jerome, Professor Jerome. Today I will be presenting question 1B of the assignment provided to us. Based on question 1A, the answers, our group is supposed to include recommendations on how the company can improve the organization's performance for the upcoming year. The first recommendation is to increase liquidity. This is to ensure a current ratio above 1, raise current assets, especially cash and receivables, while controlling liabilities. The second recommendation is to improve inventory management, which is to lower holding costs and improve turnover, adopt improved inventory management techniques. Next is to optimize debt management. This is to ensure sustainable growth, maintain a balanced debt to equity ratio, and stay clear of excessive leverage. The next recommendation is cost control. This is to increase profit margins, concentrate on lowering operating and cost of product sold costs. The next recommendation is to boost revenue, which is to stimulate revenue growth, allocate resources to marketing and sales campaign. Lastly, strengthen operational efficiency. By doing so, we reduce overhead and increase asset turnover ratios and operating profit margins by reducing operations. That's all from me. Thank you.
Good day, Dr. Jerome. I'm Rajeshwaran here, and I have contributed in my part of my group for the question 2A and 2B. So this is for 2A. All right, for the Provincial Imports Berhad Statement of Comprehensive Income for the year ended in December 31st, 2024. All right, the sales revenue was 6 million, then a minus with cost of goods sold, which was for 4.3 million, and the gross profit was 1.7 million. Then for the expenses part, I did for operating expenses, which was minus for 1.27 million, and then operating profit was 430,000, minus with interest expenses 200,000, minus with tax we up to 40%, which is 230,000. The net profit after tax was 92,000. The cash dividends were 36,800, and last but not least, the retained earnings was 55,200. For question 2B, for the Provincial Imports Berhad Statement of Financial Position for the year ended in December 31st, 2024. For the assets, I've added cash 400,000, marketable securities for 225,000, account receivable for 750,000, inventories for 1 million, and the total current asset was 2.3 million. Net fixed asset was 1.6 million, so the overall total asset was 4 million. For the liabilities and stockholders' equity, for account payable, I've added 840,000, taxes payable 95,000, notes payable 200,000, other current liabilities was 6,000, and the total current liabilities was 1.1 million. Besides that, the long-term debt was 500,000, total liabilities was 1.6 million. The common stock was 75,000, the retained earnings was 55,200, and the overall was 1.2 million, in which I've concluded that it was unbalanced. The unbalanced amount was up to 2.8 million. That is the unbalanced amount, sir. That's all from my part. Thank you very much.
Hi, I'm Poi Tong here. So analysis on the statement and the external funding, external financing. All right. Now the 2023 cost of goods sold was 1 million, meaning the variable cost is 2.75 million minus 1 million equals to 1.75 million. So the percentage is 1.75 million over 5 million, meaning it's 35%. Plus the fixed cost, it is 3.1 million. And for the operating expenses, fixed at 250,000, meaning the variable cost is 850 minus 250, meaning it's over 5 million, it is 12%. And the operating expenses on 6 million times 12% is 720,000. So at 2024, they purchased a new computer at 356,000 with depreciation of 110,000. So the operating cost is total 1,080,000. So from these statements, we can see that with the interest expenses unchanged and the long-term liabilities and common stock unchanged, right? Meaning it's not they didn't get the funding from bank and or the common stocks. So the new computer acquired should be by shareholders top-up investment. That's why they get ROI of 40% dividend payout. Thank you.